Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And the markets have been on the move, just going up and up and up and up, which is fantastic if we're already in. But today I wanted to talk about those who feel like they might have missed some of that move. I want to talk about a strategy sometimes employed by options traders who think they may be a little bit late to the party. This is going to be an interesting discussion. I'll be going at a pace, hopefully, that everybody can follow, but we have a lot to cover. Before I get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see all the familiar names. Nice to see a few new names today as well, but hello there, Janelle and Paul, Life in the Fast Lane. We have Josh and Eva and everybody else. Olga, thanks for being here. We always appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend Scott Thompson is hanging out in the chat with our live stream audience today. He's going to be watching for any questions that I can't get to just during the flow of the presentation. But Scott and I have been working together now for a couple of decades. He brings a lot of experience to this. Definitely a great resource to have. Thanks for having my back there, Scott. Scott and I would also like to issue an invitation to everybody listening, whether you're watching the live stream or whether you're watching the archive, to follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find and follow Scott on X at Scott Thompson CS. You can find and follow me on X at Cameron May CS, or you can hop over to linkedin.com/in and then /Cameron May CS again, and that'll take you to my profile. Give me a follow there, but it's the best place to connect with me in between the live streams. But let's get into this discussion of a strategy for those traders who think they might have missed the move. Still bullish, but maybe concerned about a pullback. As we do this, of course, we need to consider the risks associated with trading and investing. This is important information, so please bear it in mind. Equity and index options carry a high level of risk and are not suitable for all investors. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including a loss of principal. All right, so let's set the agenda for today's discussion. Here's how things are going to proceed. First thing that we're going to do is go have a look at those markets. We're just going to take a quick peek at the S&P 500. Spoiler alert, it's going up, which is great for positions that we're already in. However, sometimes a trader looks at recent activity as bullish as it's been, they think, oh no, I missed it. There's that fear of missing out. Missed the move, now I've just got to wait. Maybe not. We're going to be talking about a strategy today that's sometimes employed by an options trader when they think or fear they might have missed the move. It's known as a long call spread. Don't be intimidated if it's new. I'll try to explain exactly what we're doing as we're going along, but we'll be talking about the market conditions under which this strategy might be employed. We'll talk about how it's built, how it can make or lose money. And then we're going to plan and place an example trade in our paper money portfolio today. All right. So let's go right to the Thinkorswim desktop platform. Now, I kind of cheated. I have this platform loaded up. If you're not familiar with Thinkorswim, this is trading software. It's available to you free of charge from within your Schwab Online account. So let me quickly show you that. If you're not familiar with Thinkorswim, I don't want to leave you in the dust using something that you've not been acquainted with. So here, let me show you where to find this. Within your Schwab Online account, just pop up here to the Trade tab and then click on Thinkorswim Desktop. That's what this is called. It's just software. Download it. It's a complimentary suite of trading and investing resources that are available to you. But to accomplish the download, you go to the Thinkorswim Desktop link there, and then just scroll right down here where it says Thinkorswim Desktop. There's the download. This will walk you right through the download process. It'll create an icon on your computer's screen. It looks like a little splash. And then you just click on that to launch the Thinkorswim software, log in using your Schwab credentials, your Schwab username and password, and that'll take you in here, which is where we find ourselves right now. So we're in the simulated trading environment known as paper money. When logging into the software, it'll ask you, well, Cameron, are you logging into your live account, or are you here to do some practice trading, some paper money trading? So you can just do a little toggle there. but the practice version of Thinkorswim operates almost exactly like the real thing. There are definitely some little subtle differences here and there, but here we are in that simulated trading environment, and let's look at what's going on uh, with the S&P 500. Paul says, wouldn't short put vertical be better for new spread traders? Now I can't, Paul, it's a great question. I can't make qualitative calls for what may be appropriate for who as a general category of investors or traders, but I can say long call vertical, short put vertical on the same stock, on the same strikes, nearly identical trades. So one versus the other, very nominal differences between the two. All right, I know that might be surprising. I've actually done a deep examination of that in the past. I explained the math behind that. It's not a statement that I make lightly, but I do think it's a very accurate one. Anyway, so here's the S&P 500, and here's that move that I'm talking about. It's been so good. The S&P 500 down here was down about 7,300 points. We've gone up just about exactly. As a matter of fact, that low, 73.13, now we just touched 77.13. Up 400 points on a 7,300 point index. Pretty strong move to the upside, which has been great for the bulls, but let's put ourselves in the shoes of that trader who's thinking, well, it's really bullish. The markets are at all-time highs, but didn't I just miss the move? Now what do? I'm stuck. I want to do a bullish trade, but if this pulls back, I could be in hot water. Maybe or maybe not. Sometimes when a trader finds themselves in this sort of a circumstance, they employ a strategy known as a long call spread. So let me show you what that is. And I'm going to use an example stock today. Let's go to NVIDIA. Now, how did I select NVIDIA? Everybody has their own different selection process, but there tend to be some common threads in the sorts of characteristics that sort of pre-qualify a stock for potential trading of options. Not everybody sees these the same way, but definitely the price of the stock can play a role. The liquidity of the stock. If you have an illiquid stock, its options tend to be really thinly traded, and they can be hard to get into, hard to get out of, hard to trade profitably. Now, the trader might also be looking what's happening with a chart. And just like with the S&P 500, NVIDIA has recently come off a price floor. If you look at that 195 level, for the first 8 months of the last 12, boy, the stock just didn't want to stay above 195. There was a couple of days here where we spiked up above and then just worked its way right on back down below 195. Now, back in, looks like that was April, we pushed up and through on a big candle day. And now it seems that NVIDIA just hasn't wanted to close below 195. There was one day here, there was a second day here, but in both of those circumstances, we immediately recovered, got right back up above 195, and we've stayed above that. Now, for a bullish trader, they might think, great, well, then what I'll do is enter a bullish trade, maybe buy the stock as it's come up above 195, or get into some option strategy that benefits as the stock goes up. That's nice. If we did that back here at 195, it's worked out well so far. But let's just say that our trader is now concerned. This thing looks like it might be running out of steam in the short term. As bullish as the markets are, as strong as this apparent price floor appears to be, maybe we're just too late here. Well, so here's the strategy that we're going to employ. We're going to construct what's known as a long call spread. And let's see if we can set this up to work out optimally as long as our stock is above, let's say, just $200 come expiration. So it can pull back. So we're going to give this some wiggle room. Let's say that our trader thinks, oh, we might go up and through that 215 ceiling. We might come up a bump against it and pull down, but maybe their general outlook is just that the stock may have run out of steam a little bit. All right, so we're not going to place a trade that requires the stock to go dramatically higher. As a matter of fact, it's going to be a trade that can work out just fine even if the stock pulls back a bit. But it is by nature still going to be a bullish stock. But here's going to be our level. I'm going to see if we can build one right here I'm just going to draw in a line at 200 bucks just as a visual reference point. Let's just say we want the stock to just be up here somewhere as we move toward, let's plan a trade for the 21st of August. Why the 21st of August? Well, let's get this done before this next earnings announcement, because that could throw a big wrench in the works. We don't know what's going to happen with the earnings. All right. Well, we don't know what's going to happen before the earnings. Let's be honest about that. That's why we might be giving this some wiggle room. So here's the trade. Let's go to our trade tab. And if you're not familiar with options at all, let me lay this out this way. Our example strategy, our example trade is known as a long call spread. And it's constructed by buying an option and selling an option at the same time. So we're going to do our contracts for the 21st of August. Those are those contracts that end right before that earnings announcement. Yeah, and if you're not familiar with options, they really are just contracts between two market participants, two traders. There's a buyer and a seller. And so let's focus on our call options here for a moment. I'm not going to be doing any put trading today. Let's go over to the calls. And the first thing I want to focus on is this column right down the center of what's called the options chain here on our trade tab. It's known as the strike column. So we're going to strike a deal to maybe trade some shares with other traders. All right. So here's the way we're going to structure this. I'm going to go down this strike column, and remember that $200 level and that 195 level. First thing I'm going to do is buy a 195 call. And if we look at these two prices, bid price and ask price, that works just like a stock. That's basically what the options are trading for at this moment for this call option. So it looks like that's between $17.65 and $18. Let's say that it costs us right now $17.85. We're going to buy a 21st of August 195 call for $17.85. And at the same time, let me get that 7 in there. I missed that. There we go. At the same time, we're going to sell a 21st of August $200 call. And I know you're probably, if this is your first exposure to options, that's okay. Take a deep breath. I'll explain exactly what we're doing as I go. I'm sort of structuring the trade, then I'll explain the trade. But we're going to sell the 21st of August $200 call, and that looks like that's trading between $13.90 and $14.05. Let's say we can sell that for 14 bucks, just to round things off. There we go. So that's going to be our trade. I wanted to get those on the screen quickly because the markets are open and these prices are going to change. But we're going to run with these prices for now, just to give us some fixed numbers to work with. All right. So I'm going to be diving into how this spread is constructed, but let me give a suggestion for anybody that might be new to trading options. If you're brand new, welcome. It's fun to learn this stuff. There's definitely risk ahead, so be prepared for that. But I have a suggestion for you. If you want to just go step by step, learning about how options work, unfortunately, in this webcast series, I can't start at the very beginning every single week. That would rapidly get repetitive and kind of not productive. But what I've done for brand new options traders, or those who are just learning, is I put together a video series of 10 lessons that starts at the basics and then works through what options are, how they're constructed, how to trade them, even how to get a little bit fancier with them. So to find that series, what you'll do is, first of all, make sure that you're subscribed to our Trader Talks channel on YouTube. Pop down below the video stream right now, click on the subscribe button. It doesn't cost anything to do that. It only takes a moment to subscribe. But our Trader Talks channel is where you can join these live streams like the one that I'm hosting right now, or you can find the playlist for previous webcasts, including my playlist for brand new options traders. If you go to those playlists, here are all of our different webcast series. And this one right here is what I'm talking about. Start here to learn about trading options. You can just click on view full playlist and you'll see there are 10 lessons, lesson 1, lesson 2, lesson 3, and so on. What I'll do, let me paste a link in the chat for those 10 lessons. Okay. And I'll also put that link in the video description for those that are watching the recording of this webcast. All right, so you can just pop down into the description. Anyway, let's get back to here to our spread. Janelle, you're very welcome. But what is this? Let's just assume that we just placed these trades. Maybe we're brand new and we just went in there and fired them in and we didn't know exactly what we're doing. Well, what we've done when we get ourselves into this, what we call a long call spread, is we've entered into two contracts, two options contracts. So specifically, if I buy a 195 call spending $17.85, what I've done here is gotten into a contract where I've paid someone else $17.85 per share. Now, each one of these contracts represents the potential exchange of 100 shares of NVIDIA. That's what this 100 means here. So this is telling me this contract runs through the 21st of August of 2026, that lasts for 17 days, and it's for the potential exchange of 100 shares of stock. Well, I've just paid someone else conceptually $17.85 per share times 100. We can do the math on that. That's $1,785 that I'm paying to someone else to get into a contract with me. And the deal for them is they get the money, but in exchange, they give me a contractual promise. They say, hey, Cameron, I promise on demand, anytime in the next 17 days or until the 21st of August, you can buy 100 shares of stock from me for $195 per share. That's the deal. So basically, I'm paying for a discount on the current price of the stock. It's at 210 bucks. I'm paying someone else for the right to buy the shares at 195. So that's the first contract we're getting into. But at the same time, I've entered into a second contract with another trader. Now, I'm saying I. What I mean here is we, or as the hypothetical trader here. But in this case, we're selling a contract. Someone else is paying us for the right to buy shares from us. So in this case, they're paying us $14 per share. That's $1,400 that for 100 shares. Someone is paying for the right to buy same shares from us, but not for $195. In this case, they have the right to buy our shares from us for $200. So yeah, we're getting into two contracts. One that gives us the right to buy for $195. A second one that obligates us to sell those shares for $200. That sounds like a rough obligation, doesn't it? Wait a minute. Are you telling me, Cameron, that I have an obligation to sell these shares if I buy them? I have to sell them for a profit? That's what the contract says. Yep. That's the deal that we're setting up. We're spending a little bit of money here, spending a little bit of cash to set up, if this deal works out, a profitable trade. So let's do some quick math here. How much does this actually cost to set up? The net cost, also known as the net credit or the net debit of this trade, also known as the theoretical maximum loss of this trade. Well, if we spend $17.85 per share to get ourselves into one contract, but then we're paid $14 per share to get ourselves into a second contract, well, we're spending $17.85 minus $14 collected. That is $3.85. That is the net cost per share of this trade. And I keep emphasizing the word per share. It's 100 shares. So it's not just, $3 and change that comes out of my wallet, a few bills and a few coins. It's actually $385. But let's reverse the logic of this trade again. What have we actually paid $385 to get into? Well, for that cost, we now have the right to buy shares for $195 and the obligation to sell shares for $200. And what we're really looking for out of this trade is for exactly that to occur. Yes, we want to buy at $195. Yes, we want to sell at $200. That's a $5 profit if this were a free trade, but we spent $3.85. How much could we make on this trade? What is the maximum, the theoretical maximum gain on this trade? Well, If we buy the shares for 195 and sell them for 200, well, that tells me that would be a $5 profit, except we spent $3.85 to set this deal up. So it actually leaves us with $1.15. Yeah, Paul, $1.15 that we could make here. Doesn't sound like a lot. Again, if we're envisioning this in physical dollars and pennies, you telling me I get to put $1.15 in my piggy bank at the end of this trade? No, this actually is $1.15 per share times 100 shares, $115 that can be made on this trade. Might not sound like a lot, but we're not spending a lot. We're spending $3.85 to try to make $1.15. How much is that? What's the potential return here? $1.15 on a $3.85 investment is 30%. 30% in 17 days. That is a very high reward potential. That's not, ooh, great, awesome. My dad always did this when he was excited. Did anybody else, kind of a generational thing? He'd get really excited, rub his hands. Let's not get too excited yet, because as my screen says, oh, we could make, theoretically, 115 bucks. We could also lose, theoretically, 385. This is a strategy where we could lose more than we can make if the trade falls apart. Fortunately, it's more likely that we make the 115 than we lose the 385. So let's explore that now. Okay, let's go to our charts here. And I want to draw in some new things here. Let me clean things up just a little bit. Right click. How about we just remove all the drawings? Clear the drawing set. Yes. So I think what we'll do is just draw in the initial premise of the trade was basically staying above that sort of 195 level. And we actually structured it so that we actually are in good position as long as we're above 200. So let me get that drawn in there. 200, right there. We're just looking for the stock to be above $200 through the 21st of August. And I'm going to do one more thing. I'm kind of a stickler about precision. Let's put in exactly $200 here. Let's put in exactly 195 here. What you'll notice is that represents the two contracts we're getting into, $200 and 195. And I'm going to draw in a box here. Again, this is where we'd like to be as we get to the August 21st expiration, this green box. Look where we are right now. So yeah, direct your eyes to the current price of the stock. It's around $211. What might happen between now and August 21st? Well, we're concerned that the stock might pull back. All right, let's address that concern right now. Let's say the stock does kind of bump its head against this previous price ceiling and it comes down. Oh no, had we bought shares, that would be unprofitable. But with this trade, it could be perfectly profitable. If the stock goes down here, I just didn't intentionally put it down to a specific price, but around 204, good enough. Let's talk through what if it pulls down to 204, 205, 206, whatever. Well, if it's at 204 on August 21st, let's go back to the terms of the contracts we're in. We have the right at any time in the next 17 days, however the right runs out on the 21st of August, but come the 21st of August, we have to have a decision to make. We can buy shares for 195 or we don't. Well, if those shares are worth 204, do we want to buy the shares at 195? Yes. Yeah, we want to buy those shares. We're getting those at a $9 discount at that point. All right, we buy the shares, we're feeling good because they're worth 204, except we also have this obligation to sell the shares at 200. Someone has the right to buy the shares from us for $200. Are they going to do it? Yep, with very few exceptions. There are the rare exceptions where somebody just doesn't, but the vast majority, almost all of these contracts would be what we call assigned. They would buy those shares from us for 200. So if we bought them for 195 and then someone else bought those shares from us for 200 so they can own them at a discount, what are we left with? Well, now we have a realized gain of $5. We made $5 on the stock transaction. It cost us $3.85 to set this up as an option deal. Those options are now done. And we just realized the $1.15 or $115 profit on our $385 investment. That's the 30% return that we were looking for. That's if the stock goes down. So, well, if it goes down, does it get better if it goes up? No, it doesn't get better. It just feels better. What if the stock doesn't go down? What if it goes up? Let's say it goes up here to 220. Well, if the stock's up there at 220, we have the right to buy the shares for 195. Are we going to do it? Yeah, we're going to do that. If someone else has the right to buy those same shares from us for 200 and they're worth $220, are they going to do it? Yeah, they're going to buy those shares from us, again, with rare exceptions. So we buy the stock at 195, we sell for 200. It's our $5 gain minus the 385 to set this trade up. And again, we have our 30% realized return. So yeah, JR Canada makes a solid point. We will be discussing this. Minus commissions. Are commissions a consideration in this trade? Absolutely. Yep. When we go to place this trade, we'll notice we're buying one contract, selling one contract. On each one, we have to pay 65 cents. That's a total of $1.30. It's not per share, it's just $1.30. So if we were to wind up making $115, we'd have to remember to subtract the commission cost for setting this deal up. Yep, JR Canada, that is definitely a legitimate question or a legitimate observation, but I tend to leave that out when we're just going through the concept of the trade because it's one more thing to remember when we're first getting acquainted with this. So I kind of leave it toward the end where I can give it greater emphasis right at that moment so it kind of sticks in the brain as we leave, but also we're comfortable with the concept by then too. All right. So commissions are a consideration. They're not as big of a deal as they used to be, but they're still a consideration on some types of trades, options trades included. All right, so that is our strategy. So why is it called what it's called? Well, these are known as options because in this case, we paid $17, in the case of the option that we bought, we paid $17.85 to enter into a contract where we have the option, not requirement, we have the option to buy the shares for 195. And then at the same time, someone is paying us for the option to buy those same shares from us for 200. That's kind of where the terminology option comes from. But what about long call spread? Well, the call part, I think we can figure out. These are known as call options. The way that I think about call options, in the old days, all of this stuff wasn't done over a computer, it was done over the phone. And so if I had the right to buy someone shares for 195, I might make a phone call to my broker and say, you know what, I'd like to call those shares. I want to exercise my option to buy those shares. So that's the way I think about it. It's not exactly why it's referred to as a call option, but it works for me. All right. Long just refers to buying something to get into a trade. When we buy a stock, we say we're long that stock. When we buy an option, we say we're long that option. So when I bought this call, I'm long that call. Now, I did sell a call, but net, I spent money. There's a debit here. So I would say that we're more long than short, basically. So this is known as a long call strategy, but specifically it's a spread. That spread just refers to the difference between 195 and 200. One price is here, the other price is there. There's a difference, a spread between those two prices. So it's known as a long call spread, definitely a bullish strategy. Because if the stock is up here at 220, how are we feeling about this trade working out? If this stock continues to rise, the further it goes away from $200, the better we feel that this thing is going to work out like we hoped. If it starts to head down, we start to get a little bit nervous, a little sweaty under the collar, but as long as we're still above $200 as we hit that 21st of August contract expiration period, the trade is still in position to work out optimally. Couple of scenarios we haven't discussed yet. What if this trade falls apart? What if the stock, despite it being way up here at 210 bucks, What if in the next 17 days it falls all the way down, not just below 200, but it goes down below 195? Who knows? Maybe it goes all the way back down here again. Is that possible? Sure, it's possible. It just did it right there. It's not likely, but it's possible, right? So if the stock has fallen down here to 190, and we have the right to buy the shares for 195, do we want to do that? Do we want to overpay for the shares just because we have the right to? No. We say, you know what? Forget it. I'm not going to buy the shares. We just blew the $17.85. At the same time, someone else has the right to buy shares from us for 200. Do they have much motivation to overpay? Stock's only worth 190. If they want to buy the shares from us, they'd have to pay us 200. It's not in their mathematical best interest to do that. And they say, Cameron, forget it. Time's up. I don't want the shares. And so they just leave us with the $14 they paid. Great. So we keep the 14, but we spent $17.85. Our net investment of $3.85 is then lost. Yep. So if we're down below here, below 195, we lose the 385. If we're above 200, we make the 115. So which one of those scenarios is more likely with where the stock is right now? Well, it's already quite a ways above that $200 level. So it can go down, it can go up, it can go sideways. As long as it stays above 200, that's the outcome we're shooting for. It would have to fall quite some distance to get down into what we call the max loss territory. Now, both of these are labeled theoretical outcomes. There is, without us doing anything, there's a third possible outcome. We could make our money, we could lose our money, or we could come up somewhere in the middle. Let me clean things up here a little bit. Let's right click. Let's just remove that trend line. Let's remove this trend line. And let's remove this one. And let's imagine the stock does this as we're going toward that August 21st expiration. Maybe it comes down here and winds up in between 200 and 195. This changes things in a big way, all right? If the stock's at 197, it's August 21st, time for us, if we haven't bought the shares already, time to make a decision. Shares are worth 197. We can buy those for 195. It's a $2 discount. Not much of a discount, but still it's a discount that expires. So do we do it? Yes. We buy the shares for 195. They're worth 197. It's retaining $2 of value for us. It's not what we're hoping for, but it helps a little bit. At the same time, someone has the right to buy those shares from us, and this is what we might be thinking. Okay, well, I'm going to buy the shares at 195. Someone else is going to buy them for 200. We're still in good shape. No, they're not. Almost certainly not. They still could if they want to, but they probably don't want to. If the shares are only worth 197 and they have the right to buy the shares from us for 200, are they going to do it? No, they're going to say, Cameron, keep the shares. I'm not overpaying by $3. And so we wind up owning shares, and that's the end of the trade. Can you imagine how that changes the risk-reward scenario? If we own shares, now if the stock starts to move up next Monday, great, we're making even more money. If the stock continues to fall, now we're shareholders, we lose money. So yeah, if we wind up in between our strikes, just remember there's a potential that we wind up owning 100 shares for each contract we've gotten into if we allow this to get to expiration, right? So there we go. This is known as the long call spread. It is also known as a bullish spread because the preference is the stock not go down. Our preference is for the stock to go up. And let's go place our trade. How do we place that trade? Let's go to the Trade tab. Let's go, if you haven't done this before, let me just take this step by step, right? Go to the Trade tab, type your symbol in up here, come down here to the option chain, go down to the contract time frame that we've selected. In this case, we're going out there to we're going out 17 days to the 21st of August. And let's click on that date and it opens up all of these different contracts that we might trade. And what we've done in the case of the way that we structure this spread so that it's kind of geared toward, it's that strategy for traders who think they might have missed the move. if we select strike prices, the 195 and 200, we select those prices below the current price, that gives it that wiggle room to move down. The further we move down below the current price, the more wiggle room we have on this trade, but also the smaller the potential reward gets, right? So we're going with the 195, 200 strike pair. And then to place the trade, we need to buy the 195 and sell the 200. Here's how to do that. To buy an option, we go to the selected strike price and we click on the ask price. And that actually creates that buy order. Just click right on that ask price. There's a buy order. Let me minimize my left column here for just a moment. In my paper money account, it's only going to bring up an order to buy one contract to maybe trade 100 shares. By default, a paper money account, I've changed my defaults. Don't be surprised if it says plus 10 here instead of plus 1. That would be in order to buy 10 contracts, each of which represents the potential exchange of 100 shares. So that would be 1,000 shares that we might be getting ourselves into. TLS now says the trader does have the choice to potentially close this trade out before expiration if we don't want to trade the shares. We don't want to allow this to get all the way to expiration. Yeah, let's talk about that for just a moment, but let's set the trade up first. In any case, there's our buy order for the 195 call, but we need to add that sell order. So I'm going to minimize this buy order for just a moment. Go back to our 200 strike, and I'm going to hold down. Here's the sort of trick. It's not a trick, it's just the way it works. Hold down the control key on my keyboard and click on the bid price for the one that I intend to sell. And that actually adds that sell order to the existing buy order. So you can see now we have an order to buy one NVIDIA 195 call and to sell one NVIDIA 200 call. And I think we're looking like we're trying to buy this for $385. The price has moved as we were talking. Might cost us a little bit more to do this now. Let's say that we're willing to spend up to, how about $4 per share? Let's put in a limit order of $4 to try to get into this trade. Now, if we're spending $4 to get into a trade that might make $5, that only leaves $1 for reward. It also means that if we're spending $4, we can lose that $4 of risk. All right. But let's go ahead and confirm and send this order. We're going to buy this one vertical, the 195, 200, 21st of August call vertical spread. Trying to do that for $4. That would give us an investment of $400, a loss potential of $400. We'd have $100 of profit. So we do need to add the $1.30. This is back to the observation about commissions. Yep. There's a $1.30 to pay in commissions, so brings the total cost of this trade to $401.30 as a maximum. Let's send this off and see if we can get this filled. I'm going to click send. I think yep, there we go. All right, we bought it at $395. We were talking the whole time about buying it for $385. We had to spend a little bit more, a little bit greater risk, a little bit less left over for potential reward. But there was a good question raised, or not a question, it was an observation, that when a trader enters into a contract, it sounds like, you ever hear this phrase, a contract is binding? Well, that's true until the contract time frame ends or until one of the parties exits the contract. And with equity options here, we do have the choice to attempt, I have to say attempt to exit the contract. There's the possibility if a contract is illiquid, it can be difficult to get back out of these. That's why for some traders, they look at heavily traded securities like NVIDIA or like Microsoft or Apple or other very highly traded stocks, because their options also tend to be highly liquid, more heavily traded, a little bit easier to get into or out of. But what we just did is we bought to get into this spread. How do you think we might exit the spread should we choose to? We might attempt to sell it. Yep. So let's just say, for argument's sake, let's say I just, let's go down here and find our spread. Here's our NVIDIA spread on our monitor page. Let's say I wanted to exit. Well, I might just right click here and create a closing order to sell this vertical spread. We bought to get into it. We're not going to spend much time, we're not going to spend any time today on the back end management of this trade. This was more just, well, how does this trade work? How might we enter into this trade? In this webcast series, we just build on these concepts. And what I'd suggest you do is go at a pace where we're absorbing this strategy and learning more and more about it. Carlos says, can this end before the expiration date? Well, we might choose to exit it, Carlos. Yep, and assuming liquidity, we might buy out of this. It might be for a higher price than we paid, in which case we may have a realized gain at that point. We might sell it at a lower price than we paid, and we might lose money. Now, something else that might happen is that other investor who has the right to buy the shares from us for 200 bucks, they may choose to assign that right, buy those shares for 200. Well, at that point, we have the right, if we want to buy the shares for 195. Buy it at 195, sell it to the other party at 200. That would just realize the maximum gain sooner than we anticipated. Yep. So in this case, having the contracts assigned and exercised before expiration actually just speeds up the profit process. It's not a negative outcome. All right. But there we go. But we could place a trade right here to exit if we wanted to. I'm not going to do that. What I'll do is we'll follow up on this in a future webcast. But we've accomplished what I set out to do today. I wanted to talk about a strategy that's sometimes employed by traders when they think they've missed the move. And as you can see with this strategy, if the stock continues going up, great. But it's not required for a profitable outcome. This has a tolerance for a pullback, not a steep pullback. We're not talking about collapsing in value. But if we pull back, as long as our stock in this case stays above 200, we're in good shape for a good exit. All right. Everybody, hey, thanks for giving me your time. If this is your first time in one of these webcasts, I'll say, of course, I covered some territory that might not be familiar to you. So if you're new to options trading, I made a recommendation earlier in this webcast. I'm going to make that recommendation again. Make sure, first of all, that you're subscribed to our Trader Talks channel on YouTube. So it's called Trader Talks Schwab Coaching Webcasts. You can do that by clicking the subscribe button right down below the video stream right now. But this is where you can join our live streams like today. But if you need to fill in the gaps, if you want to go revisit some previous webcasts, you can find those in our playlist right here. And the recommendation that I made was that you go check out my webcast series of lessons that's for those that are brand new to trading options, where it says there's a little thumbnail there that says start here to learn about trading options. And that's a series of 10 lessons. It literally just starts with lesson 1, trading options, building block number 1, long calls. It goes through how options are built, buying and selling, and what we call multi-leg strategy. We get a little bit fancier as we go. K-Bo just says, what is closing price of the NVIDIA verticals? It changes from moment to moment. I noticed it looked like it was going to be a little bit less than what we paid as of the moment I was loading up that example exit order. But another suggestion that Scott and I definitely have for you is to follow us on social media. You can follow your favorite Schwab presenters, and I definitely suggest you do, on X or on LinkedIn. You can find and follow Scott on X at Scott Thompson CS. You can find and follow me on X at Cameron May CS. That's what my profile looks like on X. There's my handle. And if you follow me here, I post frequently. If you reply to one of my posts, like I just made a post about Amazon hitting $3 trillion and asked my followers, hey, when do you think Amazon will hit $4 trillion? Is it less than a year, 1 to 3 years, 5 years, or it's never going to get there? And as you reply to my post, I just try to reply right back to you. It allows for those lines of communication to be open when the webcast isn't live. You can also do the same thing. Hop over to linkedin.com/in and then just throw on /Cameron May CS. That'll take in my profile on LinkedIn. And if you reply to my posts here, I try to reply right back to you as well. Janelle is following me. I know that. Yep, Janelle, thanks for your comments, for frequent comments on social media. Definitely appreciate it. But Scott, thanks for helping out in chat. Everybody, thanks for watching today. I'm going to let you go. I hope to see you again next Tuesday. I don't believe I saw a survey. Nope, I didn't. But I do appreciate all the thumbs up that have already been left. Whenever you watch one of our webcasts, if you enjoyed it, click that thumbs up. Whether you're watching live or you're watching on the archive, that's a pat on the back to your presenter for a job well done. But just as importantly, it sends a signal to YouTube to keep promoting the video and let more people find these webcasts. So it helps. Thanks for doing that. Everybody, I'll see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.